First, it was Blackstone and Jonathan Gray about 90 days ago. Now we have KKR coming out deploying $2.1 billion. They are clearly calling the bottom. Folks, the bottom is in. Blackstone and KKR have said it. Is that true, Jonathan? Is that what happened? Have we just seen the bottom and we just missed it?
Yes. Put all your money into real estate right now. Every single dollar you can scrape together, the bottom is in. Nothing to worry about.
Nothing to worry about. Oh, please tell me you're kidding.
As if anybody is having trouble telling that I'm being totally sarcastic about this. Yeah, no, I mean, I've been seeing the predictable multifamily cheerleaders who, 3 months ago when Jonathan Gray made that big transaction calling the bottom, now again calling the bottom. It's the typical thing you see all the time of like, oh, these big guys did it, so therefore it's a good thing to do, or they did it, meaning they're validating my idea because I say so, right? And we see this all the time. The bottom is not in, and KKR doesn't think the bottom is in, and that's not why they did the deal.
Yeah, I think we'll break down what Blackstone and KKR did, but I want to kind of pivot to a conversation I was lucky enough to be a part of with where Ben Malla, obviously, if you don't know who Ben Malla is, big YouTuber, but more importantly, he's a commercial real estate investor, usually in hotels and strip malls, so not necessarily multifamily, so commercial, but a different segment of commercial. And Ben Malla was on stage basically saying, guys, it's bad out there. It's really, and he's saying this as an owner of assets that are in trouble. He's like, I don't, my debt's tripled. The cost of his debt's tripled. Vacancies, cost, everything's up. He's, cap rates and NOIs. It's like his banks are calling him going, we're waiving conditions. We're waiving your debt service coverage ratio. They're hoping he can survive. And he says he can, but he's like, most guys aren't like me. Most guys aren't sitting on multiple seven figures of cash that they've been in this movie before. He's like, it's just starting. And he's like, you're not even going to see most of it till 2025.
Yeah, I agree with that.
Yeah. So it's like, he's like, we're in the really early inning. And he's like, he was up there. He's like, it's horrible right now. And he's like, you ain't seen nothing yet. So you take that and you kind of go to what KKR and Blackstone are doing. I don't even think you could see the bottom yet, given how scary Ben Malla was talking.
Yeah. And so let's try to like unpack all of this because there's a lot here. But so I'm going to say Ben Malla is right. And KKR also made a move that makes sense. And those things are both true. So how could they both be true? How could it both be true that we haven't even seen the beginning of the bottom yet, but also KKR is not doing something foolish? Okay, this is what I think about it. So a group like KKR or Blackstone, they have enormous amounts of capital that they have to place. Mm-hmm. They are not like you and me or Mr. Retail Investor who's like, I really need to make 20% on my money, or I'm not going to open my wallet, or I only have a little bit of money to invest, so it's got to be the best deal I could possibly find. That is not the motivation for a group like Blackstone or KKR. They have the opposite problem. They have an enormous amount of capital that they have to place. And if they don't place it, they've got to give it back, right? And so they don't want to give it back. They want to earn their fees, but they also don't want to do bad deals, but they're making the calculation. So first of all, the opportunity to come to buy $10 billion of real estate or to buy $2 billion of real estate all at once and place all that capital at once doesn't come around that often. Right. So when it comes around, they take it seriously, and they'll probably do it at almost any point in the market cycle, as long as they can structure the deal appropriately. Right. And they've seen the examples of, like, say, Tishman Speyer back at the last peak, which, bought Stuytown in New York City for $1 billion and then handed the keys back to the bank. Right. And a lot of that had to do with the intricacies of New York City real estate, and they weren't able to decontrol apartments and all that kind of stuff that they thought they would be able to do. But nevertheless, there's that example out there of something like that. So that the KKRs out of the world and the Blackstones of the world, and I guarantee you that each of those places probably has somebody who worked at Tishman during that time working for them right now. I guarantee it. right?
Guaranteed.
Probably multiple people. So they've structured the deal appropriately, but their objective is, hey, look, we have capital in place. These are good assets that we're able to buy. We know that prices are down. We don't care if they're at the absolute bottom or not. We're getting a discount to off-peak pricing that builds in some margin of safety. And we're going to structure this so that even if the market goes down some more, it doesn't really matter to us because they're not looking to flip these properties in a couple of years. This is not a play that depends on timing the market like all those syndicators who were, doing value add and in and out in 18 months. They're not timing the market. I guarantee that these plays are either 5 or 10-year holds, and they've structured them with relatively conservative debt, and they are not looking to flip in and out. They're looking to hold these things for a substantial period of time and before selling them off. And so the fact that they're able to get a 20% discount, they're really happy, and they don't care if, we could have waited another year and get a 30% discount. The properties were available now.
Yep.
And they had to move on them. And that's all that this means. So all those people out there claiming that the bottom is in because of what KKR did they just have an agenda to push.
Oh, they're just wrong. They
Yeah.
could be scared. They could be holding on by their fingernails and hoping for any good sign to get out. Or you're right, they have their own ulterior motive.
Yeah, or
When I think of,
they're trying to get LPs interested in investing again. And right now, if you're like me and you've been trying to raise capital in this market, you understand how difficult it is. So, and certainly, I do believe it's a great time to buy real estate. I do believe that if you buy now, you have a long enough hold period, you're going to do really, really well. Right. So I think a lot of people are trying to overcome the fear amongst investors that's in the market by saying the bottom is in. But I'm like KKR. I don't really care if the bottom is in or not. Right. I think if there's an opportunity to buy something, you want to buy it now. And you just have to structure it properly to ride out whatever's coming.
Yeah. When I look at what KKR and Blackstone did, right, because their transactions are done, and then I look back at, the retail investor, I'll call them, right, not the deep pockets. Basically, what I see KKR, Blackstone, and likely others at that top echelon is they're like, hey, bring us all the deals. We're going to sift through all of them, and we're going to find a couple of A-plus opportunities. And yeah, we'll buy them at a price and terms that work for us today, right? Because they know these sellers have to get out. I think Lennar was the seller inside KKR's deal, and Lennar sold 2,100 homes, like that. For $4 billion or something. So, I think they're using their checkbook and their weight to be very opportunistic, and they should, right? That's their fiduciary duty for their capital. But when I look at the overall market, they're looking at the top 1% of deals, right? And when they find them, they'll strike. That's what they're supposed to do.
Yeah.
But when you step back and look at the overall market, and you look at an operator like Ben Mala, you realize that there's just a world of pain coming, right? Interest rates tripled, NOI is down, vacancies are up, and it's like, there's just, and
and especially, and also, another just thing about these portfolios is these portfolios are pretty diverse, right? It's not like they bought $2 billion worth of real estate in Austin, Texas. Right, which they wouldn't have done. I mean, that probably is not a good idea, right? Unless they got an amazing discount on it, right? Pennies on the dollar. But these are like spread out across the country, so it's highly diversified, right? And but what we are seeing is that in the markets that got overbuilt, where everybody, I mean, not just syndicators, but the lenders, the developers, the syndicators, they all did the same analysis, and they came to the same conclusion, and they made the same decisions. And this is what happens when you just follow the crowd, right? Even if your analysis is this is why real estate sometimes, like, you have to go beyond the analysis and look at like the meta picture, because they looked at population growth, right? They looked at job growth, they looked at rent growth, and they made the right decision based on all of those factors. Hey, let's invest in Austin or what have you. The problem is they didn't step back and say, hey, everybody else is coming to the same conclusion. They're bidding up prices, and look at all these developers pouring in, and that supply is going to hit. right?
Yeah.
That was the problem. Like, you can make the correct decision on like the granular facts in front of you, and at the same time make the absolute wrong decision when you don't kind of look at the bigger picture of the market. And this is
Yeah.
what I've been warning people about for a long time. Like, for me, I always, whenever I see a lot of people doing the same thing, whether it's like, you know, like the Nuremberg rallies, right? Or like running into the same markets, it all scares me. I don't like it when I see everyone doing the same thing and saying the same thing. It's just my
Oh yeah,
visceral, like,
I
anti-establishment,
recoil.
anti-crowd thing,
Yeah.
right? I just don't
Yeah.
like it. And it happens with investors, even when it's individuals making a lot of decisions that are all the same thing. Like, it just should scare you when you see everybody saying the same thing at the same time.
I couldn't agree with that more. I mean, one of the reasons I still speak at events is because I want to know what the audience is doing, and usually they go in swarms or packs, and I just recoil. I'm like, you all are going that way. I don't know what that is, and hey, it might work out, but I am not going that way. That much I can tell you right now, because
Yeah.
the
It's
chances that all of you are right are not great.
it's just, and it's just a funny thing though. Like, everybody can be right for a while,
Correct.
right? Like, all the people, I mean, this, you could paraphrase Abraham Lincoln somehow here if you can get this right, but like, all the people could be right some of the time, but all the
Mm,
people won't be right all the time, right?
correct.
And
Yeah.
and as soon as all the people start thinking that they're right all the time, then you know that this is like a big problem. And again, like, if everybody is doing the same thing, you think of it as like, even though a lot of money was printed and whatever, there's still a finite supply of it, right? And if it's all going somewhere, that means it's not going somewhere else. And you got to look for those somewhere else's, right? That's where the money is made. It's just like Warren Buffett says, you can't do, I mean, I forget what the exact phrase is, but he says, you can't do well by doing the same thing as everybody else. Like, you can't, gosh, I wish I could remember what that phrase is. You can't, what is it? You can't do the same trade as everybody else and expect to do well. He
Yeah,
said it much
something
better
like
than I
that.
did. But the whole
Yeah.
idea is that if you're doing that, I know what he said. He said, you can't make money doing what's popular.
Mm.
Now I seem to have lost you.
Yeah. Nope. You're there. We heard it the whole
Okay.
time. You can't do
Okay.
you can't be, say it one more time.
It's like, you can't do what's popular and make money.
There you go. Yeah. I love that. Well,
Yeah.
the other thing that's going on is you have folks like Grant Cardone, Ken McElroy, and others really pointing at the fact that, yeah, we have a lot of inventory coming online, right? A lot of people have written about all this inventory coming online in the Sun Belt, but these guys now are pointing at building permits and the lack of new projects going on. And both of those guys are really saying, hey, in a year or in a year and a half, watch out,
Yeah.
right? We could have another cycle of inflation. Again, I don't know if these are just those two guys talking their book. Maybe they're both heavily invested there. I have no idea, but it does. Supply and demand's undefeated, right? We do have a lot of supply coming. That is a true statement, but it's also a true statement to say that there's a huge gap behind that. So I'm just curious, what do you think of all that?
Yeah. I mean, this is really just the real estate cycle in real time, right?
Right.
Like, this is what, now I forget what, if you guys saw my real estate cycle presentation a couple of weeks ago, right?
Yep.
There's Dr. Mueller came up with the real estate cycle. And this is exactly what it is. It's like, you get, overbuilding. Overbuilding causes a crash, right? When the crash happens, the building just stops dead, and then you get
Mhm.
absorption. And at some point, it's all absorbed. And then when it's all absorbed and you're back up to market, sort of the median market occupancy, then the rents start to climb. And if you get in at that point where the you're below the long-term market occupancy, but you're also past the trough, right? So like, in that sweet spot between the very bottom, when occupancy bottoms out, but you're not yet at market occupancy or long-term market occupancy, then you can buy a lot of distress, but buy it into a rising rent growth environment, right? And that's kind of that's probably what those guys are talking about. And they've been through a few cycles and they've seen
Ah,
it, especially someone like Ken McElroy, that you can, if you've got cash on hand, you know, that's where you can
Yeah.
really make money. Or even now, if you go in, I mean, think about this kind of play, like forget about interest rates. Like who cares? If you can go in and buy at low leverage,
Mhm.
right? So buy at very conservative leverage. So your debt service, like you know that at reduced occupancies, you can cover your debt service. And then you just ride out that bottom of the trough because you know it's coming because development is drying up. And then you in that rising environment, when rent growth comes back, then you refinance. You can
Yep.
probably get all your equity out, right?
Probably.
And
Yeah.
refinance at 75%. And then, you're good. So that's what those guys are looking to do. If you've got cash, I mean, it's a great
Yeah.
time.
No, I couldn't agree more with that. And I think Ken McElroy's doing all of us a pretty good service because he's kind of putting his playbook out there. I kind of think what Ken's doing is kind of the old, Jeff Bezos. I wish I had Jeff Bezos at Amazon in the early days. I think Ken is doing a fairly good job of articulating how he's going to deploy $1 billion in this cycle, right? The next couple of years. So I want to give him full credit for kind of just laying out the playbook in real time. So much appreciated. I don't know if you saw this. Oh, go ahead.
I was just going to say, we should go back to the Ben Mala
Oh yeah,
statements and kind of unpack those,
let's do that first.
before
Let's
we
go
move
back to
on.
Ben
Yeah.
Mallow. Where do you want to
Yeah.
how do you want to unravel
Yeah,
kind of
well,
what
I
he
just want to kind of like unpack it a little bit more for people to understand what's going on. I didn't hear the talk, but I can guess what it's about. Um, you know, we've had, is it triple or quadruple whammy in multifamily
yeah,
real estate of
it's
rising
bad.
supply, you know, hi, higher vacancies, lack of rent growth or even concessions, plus rising expenses, plus people bought at the top of the market, right? So all these things are all happening at the same time. And what the only play really available to lenders at this, because I'll give you an example. I'm involved in a deal that kind of meets those characteristics, right? And so we've had to do capital calls, and we've come up with a strategy to ride it out, right? And I think we're in pretty good shape for riding it out. But um, you know, some of the principals looked into the pool that this loan is part of, right? And this was basically, bridge debt issued at the top of the market. The entire pool, the DSCR is under one. The
Yeah,
average DSCR is
that's
under
not
one
good.
for the entire pool, which means none of the loans, are like 20 loans in there, are making their debt service. And if you extrapolate this across the entire, basically all the deals done with bridge debt in 2021 and 2022, I guarantee you that the number of deals that are making their debt service fully, right, without dipping into, they may be making the debt service, because they're dipping into investors' pockets to do it.
Right.
But the properties that are making debt service on an operating basis are vanishingly small. And
Yeah,
so
exactly.
the lenders really have no choice except to just restructure this debt and try to kick the can down the road. And so that means stuff like getting rid of DSCR tests, waiving the cap. They're not making people buy rate caps because, like, what's the point of that? They can just restructure it.
Yeah.
They're basically giving up all of their sort of profitability on these loans so that they have a shot at being made whole and just getting their money out,
Yeah.
because they know that, because everybody's seen this movie before, if they all start foreclosing and they sell these properties, all it's going to do is impair their capital even more, right?
Yep.
By
And
driving the price
faster.
down and faster,
That's
right?
that's the key.
Yeah.
That's really what Ben Mallow was talking about with extend and pretend is there's undoubtedly going to be some stress and foreclosures, but what the banks are trying to do is trying to extend it over a longer duration. So there's just not this cataclysmic,
Yeah.
pivot
And
down.
I've said in the past that that the lenders can only extend and pretend so long before they will just start to try to get some capital back and start foreclosing, and then it all happens. But I'm actually rethinking that now, because thinking about, like, the example of Japan in the
Yeah.
90s and early
Good call. Yeah.
2000s, they just had thousands of what they called zombie companies that
Yep.
where they were just kept on rolling over the debt and rolling over the debt and rolling over the debt and hoping that like someday they were going to outgrow the debt. And I think you may find this, you know, because I think there's a lot more data out there than there used to be.
Hmm.
There's a lot more reporting agencies, you know, so all this debt is, you can buy all this data, right? So they're all looking at the data and they know what's going on. And I think they're going to be looking at this and saying like, well, it's 2027. We also can't all foreclose now because the same thing will happen.
Yeah.
So, and this could create like a pretty long drag on the market if you think about it, where
Hmm.
there's just all these sort of zombie properties just waiting for enough rent growth and NOI growth to like finally be at the stage where they can sell and repay the debt, and you'll just see the debt just keep on getting extended and extended until that
Yeah.
plays out.
It's really a weird time because again, I think the other thing that you and I have talked about over the years that I still or months that I still think is true is Class A stuff generally is starting to trade. You're starting to get comps. The Class B and Class C stuff is frankly where all the stress is, right? It was all the value add, bridge
Yeah.
debt stuff. That stuff's not retrading. And I think you and I were in sync that we thought maybe the top 10% of kind of, principles, they would get permission to extend and pretend, and then, everybody below that would be suffering. But I think you're right. I think I still think there's going to be plenty of foreclosures because I remember a building that we bought in the last cycle. The seller at the time wanted to sell it for 1.44 million. Why? Because that's what he bought it for. The bank or the lender basically let him run for 2 years, but the asset fell apart because the
Yeah.
the seller, the owner, didn't repair a thing because not throwing good money after bad, and
So
and we bought it for half price.
so here's this kind of dovetails nicely with something that I've been talking about a lot online recently. So I don't know if you guys have been following me on LinkedIn or listened to me on some other podcasts, but the whole the whole idea of what value add is changed fundamentally during the bubble, right? So that, and I think a lot of people have been in the market for a short enough time. I'd say basically anybody who came into the market after 2016 doesn't actually know what a value add deal is,
Mhm.
right? Now, a value add deal, to my mind, is you buy a property that is like a mismatch for the neighborhood, right? Or it's distressed. Maybe it's vacant or it's really low occupancy, or it's just, the neighborhood is now like, an up and coming, B plus market. And this is the one of the crappy C deals that's left there.
Mhm.
The idea is you go and you completely re-tenant it, renovate the whole thing, right? It takes a year to 18 months,
Yeah.
but you basically, by the time you're done, you're basically left with only a few of the tenants that you started out with because most of those tenants couldn't afford the new rents, right? And so you've basically changed completely changed the character of the place. And the value add comes from the fact that you buy it for the current valuation, which is low because of the bad tenants, the low rents, all that sort of stuff, and you transform the asset into something much more valuable, and you make money because the cost of the transformation is less than the value you create, right? So you create 2 million, you buy $1 million property, you put $1 million into it, and now you got a $4 million property. Like that's the idea, right?
Yeah.
What happened after 2016 was that so many people piled into value add that the pricing got really crazy. And instead of paying the $1 million for the property worth $1 million, you were paying, 3 million for it, and you had to put another million into it, and then it was worth 4, and basically you're kind of in and out for the same amount of money, right? I mean, you basically the sellers were saying, hey, pay me what it will be worth when you're done, right?
Yep.
And so the only way that they could actually make money doing that was to not do the value add,
Yep.
right? You couldn't spend the money on the value add and then make money because basically all of the upside had been arbitraged out. So the game became buy it, do 20% of the markets, raise the rent, and then tell the next guy, hey, pay me for the future value, right?
Yeah.
And then the cycle repeated itself, which is why you saw the same deals trading 3, 4, 5 times as a value add every single time, which made no sense if you thought about it. It can only be a value add once per
Mhm.
cycle. right? Like you do the value add, it's good for 10 years, but after 10 years, the apartments are out of date. You do it all over again. But you can't add, like, the second value add became like, okay, we're gonna change out the hardware on the on the cabinets, right? Because the
Right.
first value add went in and they put in new cabinets. The second value add, what are you gonna do? Right? You're not gonna upgrade you're not gonna get the rents, right? So
Right.
so basically, and so now what you're seeing is the confluence of all the costs rising and the people who, were like kind of into a value add, but they didn't actually do the value add. They were the ones who got caught short. That's why you see these deals with like the DSCRs of like 4, 0.4,
Right.
because they were supposed to get in and out before they
Right.
ever had a problem with their DSCR. And then, but they were the ones where, without a
Music
chair when the
stopped.
music
Yep.
stops.
Yep.
Exactly. Right. So they had an asset where they, it's like, oh my God, you were supposed to, well, we never expected to actually do the value add. We were just going to
Yeah.
like raise the money and then pay our investors with their own funds and then give them back their own money at the end of the deal with a little bit of profit. And you call it a profit and like all this sort of stuff. And there was no value add being done. It was just
Yeah.
do 20% of the units and flip it to the next person. So now the people who got caught short, those are the ones who are going to get foreclosed on, because those are the ones who can't actually do the value add. The lenders don't trust them to do the value add. They have no track record
Exactly.
of doing it. They'll get foreclosed on. The lenders will take a huge haircut. The investors will all be wiped out, and somebody will
Well,
buy those
let's
deals
talk
for
about
a
that
really good
huge cut.
basis.
Yeah, that's what I see coming. Because again, and I want to put some numbers. You and I, again, we turned a $100 million building into 48 million a year and a half ago. So
Yeah.
we knew this was coming. Let's just use 100 million. Let's say the last sucker that bought it for is 100 million. At the time, given the bridge debt, they probably get 70 million, right? The equity's 30. Is that reasonable?
Yeah. Yeah. Probably
Okay.
even, maybe even actually with bridge debt, they could get even more.
All
So
right. So
they might have been
25,
getting 80% plus,
80%. Okay.
plus, plus renovation funds too for bridge debt. So they could have
All right.
had an actual like, loan to cost of like 90%.
Yeah. So oh wow. So wow, that's crazy. We'll do 75
Mhm.
just to make the math better. So again, $100 million building, you got a loan for 75, equities 25. The music stopped, they don't have a chair, you know, cap rates going the wrong way, cap rate expansion not collapsing, NOIs going the wrong way, vacancy, it's all bad, right? It's the 4 or 5 things going bad. I mean, what might this asset really be worth? Like the equity is clearly gone. And I think some of the debt is impaired, but it's not going to be like the residential collapse where the banks were on the hook for, almost all of the debt. The equity is, you know, the equity goes first, right?
Yeah, the equity gets wiped out first, but let's just, you know, play it out real simple. Let's just say you bought at a 4% cap rate,
Mhm.
which was quite common in some of the hot
Sure.
markets.
Absolutely.
In Texas, deals were trading at 3.75, right? But let's just say the cap rate goes from 4% to 5%, which they have, right? And sometimes a little more, but let's just make it easy. It doesn't sound like a lot. No, it goes from 4% to 5%. That's 20%. So you've
Yeah.
lost 20%, and that's assuming that nothing else has
Yeah. That's
changed.
assuming the NOI hasn't changed, which I
Right.
think we all know it's gone
Yeah.
the wrong way also.
So that assumes that your occupancy is the same, your costs are the same, and we know that those things have not happened, right? So if your occupancy, let's just say your occupancy has dropped, everything else being held equal. Let's say your occupancy has dropped from, you know, 95 to 90%, right?
Okay.
Now again, 90% considered stabilized. Fannie and Freddie will lend on it if it's consistently 90%.
Yeah.
They say, well, 5%. I've lost another 5% of value, equity's gone. No, 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 no. You've actually lost 10% of your value
Mhm.
from 5% occupancy because,
Right.
you're running at assuming you're running at a 50% expense ratio,
Correct.
that means that your NOI is down by 10%, right? So now you're actually impairing the loan as well as having wiped out all the equity, right? So,
Exactly.
and you just see this, you know, and then if your NOI has taken a further hit because your insurance doubled, which
Hmm.
in some
Which
places
has
it did,
happened. Yeah.
or if you're in Texas and your property taxes shot through the roof, right?
Yep.
um, you could be easily looking at 50 cents on the dollar in terms
Yeah.
of
So
Okay.
there's a chance this $100 million building bought at the wrong time with the wrong debt could be worth 50 or 60 million.
Yeah.
So equity gone, banks impaired, 15 to 20 million bucks. And that's really what I hear Ben Mala saying. He's like, guys, you have no idea. All of this is still coming.
Yeah. And you can see in that situation that maybe the banks, they're sitting there thinking like, well, God, we've got 50 of these. And it's all the same thing.
Yeah.
So what are they going to do other than just extend the loan, try to restructure it, and then just hope that you can kind
Well,
of grow? And
here's
they're looking,
the rub though, because I've been here before. I think in a lot of situations, Jonathan, they have to change the operator. Because again, the operator is looking at this going, I don't win. The bank's going to call me as soon as the value equals the debt. I'm not working for free. I mean, that's what Olivia and I saw in this building at 144. The owner knew that any dollar he put in to fix anything was gone. So he didn't do anything. And the bank didn't realize the distress. The asset went from being a decent B plus to a D.
so on some of these assets, you know, there were, when the property is purchased, escrows either out of equity or out of debt for rehabs. And what you're seeing now is some of that money as part of the restructuring being released to the operators. Like the condition of the restructuring of the loan is that this money will be used to complete the improvements. So you are seeing some of that, but on smaller deals, probably not. Smaller deals that are thinly capitalized, you might see exactly that phenomenon happening where people, just are not going to put money in. I think though that maybe at the lower end though, at least sort of what I have been seeing in terms of debt being offered when I'm talking with smaller banks, I think that the smaller banks, they keep these loans on their balance sheet.
They
They
do.
were more conservative in this cycle than in the past. So they
They
may
were.
have extended.
I have some of these, right? They're more like 65 if they're going to
Yeah,
keep
exactly.
them.
So there's more cushion there for the lenders. So I think that for those lenders, they may not, maybe more than the last cycle, they may be able to kind of like extend and do workouts and stuff,
Yeah, but the key, this is the key in this cycle. Again, I'm looking to buy stuff. Let's just be clear. I'm
Yeah.
looking to add some more distressed units and ride the cycle again. The bank or the lenders, they've really got to this is where you've got to meet the operator quarterly or something, because again, there will be some operators that have just given up and not told the bank.
Yeah.
They're hoping for some 1031 miracle, buyer that just, needs to do something stupid. Um, I just think there's going to be a lot of, and again, I'm talking 5 to 50. I'm not talking any institutional quality stuff.
Yeah.
I just think there's some owners that have bad debt structures that are in no-win situations, and the bank's not foreclosing for whatever reason, and they're just going to bleed the property,
Yeah.
and that's where it ends up.
I agree. And just one other piece of like anecdotal evidence to add to all of this is that something that's going on right now is so everybody knows volume is way down, transaction volume.
Mm-hmm.
There are a lot of deals that are being marketed and then being pulled because nobody's making an offer that is,
I'm seeing
um,
that too.
that's what
And
the
that's
seller
the
needs.
start of this cycle, right? You're an
Yeah.
owner, your bank whispers in your ear, we're not going to refi you or whatever the, problem. You're going to list it. You're going to list it at some stupid price to get you out, hoping for a 1031 idiot. And then you pull it because there's no activity. And
And,
that's where we are.
and here's something else. Yeah, if you guys should do this for fun, um, get onto Crexy. Crexy has gone big into auctions, right? So
Oh,
Crexy is running auctions all the time. And when you log into Crexy, it's the first thing you see is the auctions running. Just go through the auctions and see how many of those deals have like, half an hour to go, an hour to go, and the reserve has not been met.
yeah.
It's like all of them. When I looked this morning, there was like one deal where the reserve had been met. And guess where that deal was?
No idea.
In the hellhole of all hellholes, where nobody wants to invest, right here in New York City.
Oh, really?
Yes, right here in New York City. That is the one deal though the reserve is met and there's a bidding war going on. But
Wow, that's funny.
all these other deals in the Sun Belt and whatnot, like
Yeah, I think that's a
they're
sign.
not
Also,
met.
I think I think the Sun Belt is overplayed. I think there's just a lot of bad debt. It's back to the core markets. I mean, it's funny you say that. I could actually imagine a San Francisco building of all the places I would never touch. I can imagine a bidding war in because it's closer to the bottom than the top.
It's coming back. I mean, I've been hearing that San Francisco has turned the corner, and that like people are starting to bring money back into the city. And
I'm actually hearing the same thing. Now it's
yeah,
not, it's early. It could certainly
yeah.
stop. But I have some friends that have committed brand new capital and gotten they're buying stuff at like 1909 prices. Like this San Francisco hasn't been that cheap since the early 1900s.
Yeah, well, I mean, same thing in New York City. I mean, I talked with the Japanese corporate partners that I work with, and they called me the other day and they're like, "Hey, we're restarting things because we're starting to get, interest from Japanese investors in New York City property, despite
Funny.
the fact that the yen has tanked, right?
Yeah.
So it's like,
Yeah.
you know, people smell a bargain and they want in, right?
Yeah,
So
it's pretty cool. Well, the last thing I wanted to touch on with you, I don't know if you saw this, but the 31 largest banks just completed their stress test. And instead of arguing whether or not that was good or bad, I actually want to share with you the criteria that they
okay.
were judged against, and then ask you very simply what the hell the Fed would do if this happened.
Hmm.
You ready?
Okay.
So there were three variables. Unemployment spikes to 10%. Commercial real estate collapses 40%. Single family homes collapse 36%. So I ask you, Jonathan, one simple question. If all of that happened, what the heck would the Fed do?
I mean, I think they would have no choice but to like slash rates to zero again. Yeah.
Exactly. They
Yeah.
go to zero.
Yeah.
I would actually argue if one of those things happened, they go to zero, let alone
That's
all three.
although I would imagine they probably are linked, right? I don't think you'd see any of those
No,
things
for
happen. I
sure.
mean, maybe you could see a commercial real estate collapse without the
Yeah,
rest of it
you
happening.
could.
Yeah. And I don't think
Yeah,
that the
given
Fed
the
would
debt.
go, yeah, I don't think that the Fed would go to
I
zero
think
interest
that's
rates
fair.
to save commercial real estate.
No, I agree. I would agree with
Yeah.
that. It's to your point. It's one of the other two
Yeah.
that would go. Hey, time to get the party started again. Let's go to zero. This is a lot of fun. So at the end of the day, just to go back where we started with Blackstone and KKR calling the bottom. I think it's both fair to say that that is just simply not true. If you hear somebody parroting that phrase, they probably are either in a lot of pain or they are trying to motivate you to do something. So a lot of good stuff. So Jonathan, where could people follow you? Because you're putting out all this good stuff and really talking about the real. Where can they follow you?
Yeah, these days LinkedIn is the best place to follow me. Um, but I also have a school group, just like Michael, about
Oh,
real estate
nice.
investing. Yeah, so it's called the Apartment Investors Club, as you might have guessed. So come on and join us there.
Very, very cool, Jonathan. You're amazing, man. Thank you so much.
Thank you, Michael.